Every professional trader you admire has experienced this moment. Price moves violently against you, and your mind goes blank. The screen becomes a blur. The numbers seem to stop making sense. Your hands freeze on the keyboard. Your breathing becomes shallow. Time seems to slow down and speed up simultaneously. In that moment, you are no longer a trader making a deliberate decision. You are an animal in survival mode. The amateur freezes in this moment. He stares at the screen, hoping for a bounce that never comes. He tells himself that if he just waits a little longer, if he just holds on a little harder, the market will come back to him. It won't. The professional executes a 60-second decision protocol that most traders have never heard of. He doesn't freeze. His hands move. His mind clicks through a series of pre-programmed gates. 60 seconds later, he's made a decision. He's executed. He's moved on. The difference between these two responses determines everything about your future as a trader. Here's the brutal truth that separates the survivors from the casualties. In volatile markets, hesitation doesn't protect you. It annihilates you. Hesitation is slow death. Hesitation is when you watch your account evaporate in real time, watching every percentage point of loss accumulate while your brain searches for a reason to act. A trader in 2019 held a short position into a flash crash. This was a significant position. He'd done his homework. He'd sized appropriately for normal market conditions. Then the market gapped against him violently. He had 30 seconds to decide, close the loss and move on, or hold and hope for a reversal. He froze. He was hoping the price would bounce. It didn't. He was hoping that his thesis was somehow still intact despite the violent move against him. It wasn't. His account evaporated by 40% in that single frozen moment. That's not a typo. 40% of his entire account capital disappeared because he couldn't make a decision in 30 seconds. The professionals around him, the ones who were trading the same market with similar positions, were using a structured 1-minute framework. They weren't hoping. They weren't frozen. They were executing. They exited with 2% losses instead. 38 percentage points separated the frozen trader from the professionals. That gap is the difference between ruin and recovery. That gap is the difference between watching your dream of trading die and building a sustainable, profitable career. You've been taught that good trading is slow, methodical, and unemotional. That's partially true. The long-term arc of trading is indeed slow. Position sizing should be methodical. Risk management should be systematic and unemotional. But the first decision in a crisis, the initial 60 seconds after volatility strikes, operates under entirely different rules. In those 60 seconds, you don't have time for contemplation. You don't have time to meditate or journal or call your mentor or run back tests. You have 60 seconds to move from panic to clarity. You have 1 minute to move from survival mode to professional execution. The 1-minute panic formula isn't about being faster than the market. It's not about reflexes or instincts or some mystical trading intuition. It's about being faster than your fear. It's about having a preloaded checklist so that when volatility strikes, your brain doesn't make the decision. Your protocol does. Your fear becomes irrelevant because you've already decided what you'll do before the fear ever arrived. Your amygdala becomes irrelevant because your nervous system has already memorized the response. Amateur traders treat panic as a sudden shock, an enemy to resist. They see volatility spike, and they think this is unexpected, this is unfair, this shouldn't be happening. Their mind is trying to solve panic in real time, which is impossible. Panic is a neurological event, not a puzzle to solve. Professional traders treat panic as a scheduled guest. They know it's coming. Maybe not today, maybe not this week, but it's coming. They've rehearsed the greeting 100 times. When fear arrives, they're already 3 steps ahead. They're not thinking, they're executing. There's a crucial difference between thinking and executing when real money is at risk. In the next few minutes, I'm going to expose you to a nested decision tree that hedge fund traders use to navigate flash crashes, earnings shocks, gap openings, and geopolitical surprises. This isn't theoretical. This isn't academic. This is the exact framework that professionals have been using for decades to separate themselves from the amateurs. By the end of this video, you'll have a mental framework that turns seconds of chaos into moments of clarity. You'll understand that panic isn't your enemy. Indecision is. You'll know that the solution isn't to be fearless. The solution is to be prepared. But here's the catch, and this is critical. This formula only works if you've already committed to it before panic arrives. That's the hidden rule most traders miss. They watch this video, and they nod in agreement. They feel inspired. They feel like they've learned something valuable. They feel like they understand the framework. Then they close the video, they go back to trading. And when volatility strikes, when the flash crash comes, when earnings gap against them, when geopolitical news shocks the market, they freeze anyway. They didn't anchor the formula into muscle memory. They didn't practice it, they didn't simulate it, they just understood it intellectually. Understanding is not enough. The traders who survive don't have better instincts than you. They don't have access to better information. They don't have some genetic predisposition to courage or clarity. They have better predecisions. They've already said yes or no before the trigger is pulled. They've already walked through the decision tree 100 times before the market ever tests them. They've already rehearsed so thoroughly that when panic arrives, their hands move before their mind even catches up. The question that will haunt you for the next 60 seconds is this: will you be someone who plans under pressure, scrambling through the framework as panic crashes down around you? Or will you be someone who already planned before pressure arrived, who rehearsed the protocol until it became automatic? That's the real question. Not whether you understand the framework, whether you're willing to anchor it, whether you're willing to practice it, whether you're willing to become the kind of trader who executes instead of freezes. Let's install that protocol now. And more importantly, let's commit to making it automatic before the next crisis arrives. The 1-minute panic formula rests on 3 sequential gates. You pass through each one in roughly 20 seconds. If you fail at any gate, you execute. If you pass all 3, you hold. Most amateurs never identify the gates. They just panic and sell. But professionals have memorized this system so thoroughly that when volatility strikes, their hands move through each gate automatically. The gates aren't complicated. They're brutally simple. And that simplicity is precisely why they work when everything else fails. When volatility spikes, your amygdala floods you with cortisol. Your first instinct is to assume the worst. The trade is broken. The thesis is dead. You're ruined. That's rarely true. Gate 1 forces you to answer one question in roughly 20 seconds. Has the fundamental thesis changed? Or has price just moved? This distinction separates traders who survive from traders who capitulate. A trader held a long position in a tech stock. Earnings came out. Stock dropped 8% in 2 minutes. His instinct screamed, "Get out, you're wrong." But he paused. The earnings beat expectations. The drop was panic-driven, not thesis-driven. He passed gate 1. Within an hour, the stock rallied 12%. The amateurs who couldn't separate panic from reality locked in losses. They saw the 8% drop and assumed it meant their thesis was broken. They didn't ask, was I wrong about the company, or was I right and the market is just panicking? That single question, that single gate, determined whether they captured the 12% rally or crystallized the loss. Gate 1 is your emotional firewall. It's the moment where you stop reacting and start thinking. It asks 3 sub-questions in rapid sequence. Is this a fundamental invalidation of my thesis? Or is this just intraday noise? Have the earnings, the news, the data changed my conviction? Or have they changed only the price? Would I enter this trade again at this price if I didn't already hold it? If the answer to that third question is yes, if you'd buy more at this lower price, then your thesis is intact. Your panic is just your amygdala being amygdala. Gate 1 passes. You move to gate 2. Now you've confirmed your thesis is intact. The next question emerges. Is your position size still appropriate given the new volatility regime? This is where professionals differ radically from amateurs. Amateurs think position sizing is set and forget. They enter a trade at 2% account risk, and they never recalibrate. They assume that 2% tomorrow means the same thing as 2% today. Professionals know that when volatility doubles, your effective leverage doubles. A 2% position in calm conditions becomes a 4% position in chaos. The same dollar amount of risk now represents twice the psychological weight because the market is twice as unstable. A hedge fund manager was long equities during a geopolitical spike. His thesis was sound, fundamentals were intact, the long-term trend was up, the position was based on conviction, not emotion. But his position size, calibrated for normal volatility, was now too large for the new regime. He didn't panic sell. Instead, he reduced size by 40%. locking in a small loss but preserving dry powder for re-entry at better levels. He passed Gate 1, thesis intact, but failed Gate 2, sizing no longer appropriate for volatility. So he took action, not a panic action, but a professional action. He reduced. The trader next to him, same thesis, same initial position, but unable to resize, unable to even articulate what Gate 2 was asking, held the full position and eventually capitulated with a 15% loss when volatility spiked again 2 weeks later. The hedge fund manager who resized, he bought back 25% of the position 3 days later at even better prices, turning his small loss into a profitable trade. Gate 2 asks a simple question. Given this volatility level, am I still sized correctly? If the answer is no, you don't sell the entire position. You resize. You don't panic exit. You adjust. This is the move that amateurs never make because they don't even know Gate 2 exists. They think trading is enter and hold or enter and exit. They don't know that the professional play is sometimes enter and adjust. Final gate, why did I enter this trade? If my reason was a 5-minute scalp and we're now 20 minutes in, exit. If my reason was a swing trade over 3 days and we're now seeing an expected pullback within that 3-day arc, hold. If my reason was a long-term position based on quarterly fundamentals and we're now just watching intraday noise, definitely hold. This is where Jesse Livermore's waiting is. Position maxim lives. The amateur can't tell the difference between healthy retracement and a broken trade. The amateur sees price drop 3% and thinks, this is wrong, get out. The professional sees price drop 3% and thinks, is this intraday pullback within my expected range, or is this the beginning of a larger reversal? The answer determines whether Gate 3 passes or fails. A trader entered a swing position on Monday morning, betting on a 3-day consolidation followed by a breakout on Friday. By Tuesday afternoon, the stock had retraced 5% from his entry. Gate 1 passed. The thesis was intact. Fundamentals hadn't changed. Gate 2 passed. His position size was still appropriate for the volatility. But now Gate 3. Did he enter because he expected a smooth ride, or did he enter because he expected exactly this kind of pullback? He entered because he expected it. The retracement was part of the trade, not a negation of it. He held. Friday came. The breakout happened. The stock moved 12% higher from his entry. The amateur holding the same position exited on Tuesday, locking in a 5% loss, and then watched the stock rally, 12% without him. Is the power of Gate 3. It forces you to distinguish between thesis-aligned retracement and thesis-invalidating reversal. Your entry thesis dictates your holding thesis. If you entered because you expected volatility, then volatility arriving doesn't invalidate your thesis, it confirms it. The professional knows this, the amateur doesn't. So when Gate 3 arrives, the professional asks, am I seeing what I expected to see? If yes, hold. If no, reassess. If the answer is truly no, if the market is doing something you genuinely didn't expect, then maybe Gate 3 fails, maybe you exit. But that's a decision based on data, not on emotion. The 3 gates, thesis integrity, position sizing, time horizon alignment, collapse the infinite compel. Exity of panic into 3 20-second decision nodes. You don't have time to philosophize. You don't have time to journal your feelings. You have time to ask 3 questions and move forward. Professionals have rehearsed these 3 gates so thoroughly that when volatility strikes, they don't think, they execute. Their hands move through the gates automatically, and by the time 60 seconds have elapsed, they have made a decision that separates them from the 95% of traders who freeze. The gates aren't magic, they're just discipline made systematic. And discipline made systematic becomes automatic, becomes professional. Now here's where amateurs and professionals truly diverge. What do you do after you've passed the 3 gates and decided to hold? Do you add to a winning position? Do you sit still? Do you reduce? The answer to these questions determines whether you're building wealth or slowly destroying it through emotional decision-making disguised as conviction. Most traders never even ask themselves these questions. They just react. They see a position moving in their favor and they add. They see a position moving against them and they panic. The pyramid rule is the most dangerous rule in the trader's toolkit, which is why most traders have never heard of it. And if they have heard of it, they've misunderstood it so thoroughly that it's become a liability instead of an asset. Pyramiding is when you add to a winning position as it moves in your favor. Sounds obvious, right? Add to winners, not losers. That's what every motivational trading book tells you. Let your winners run and cut your losers fast. That's conventional wisdom. But here's the brutal reality. 87% of traders who pyramid blow up. Not eventually. Not after years of compounding mistakes. Blow up catastrophically, losing 30%, 40%, 50% of their account in single positions. Why? Because they pyramid a T. Key exact moment volatility is highest, and they have the least emotional clarity. They pyramid when their amygdala is hijacked by euphoria. They pyramid when they should be sitting still. And then when volatility reverses, when the market corrects as markets do, their larger position amplifies their anxiety, and they panic sell at the worst possible time. Here's the real rule, the one that separates the 13% who pyramid successfully from the 87% who blow up. Pyramid only after a confirmed reversal, not during initial volatility. This sounds technical, but the psychology behind it is everything. A trader saw a stock break above resistance at $50. Classic breakout setup, high probability. He bought 100 shares. In the next 30 minutes, it rallied to $52. His thesis was working, price was moving. He felt euphoric, that specific cocktail of dopamine and serotonin that tells your brain you're winning. And at that exact moment, when his emotional clarity was at its lowest, he made a decision. He bought another 100 shares. His average was now $51. His position had doubled. His conviction had doubled. His emotional weight had doubled. Then the stock crashed to $48. In absolute dollar terms, he was now down more than he ever would have been with his original position. His anxiety doubled right along with his position size. His mind started spiraling. I was wrong. The breakout failed. Get out, get out, get out. He panic sold at $48, locking in a loss on the entire position. His emotional weight had destroyed him. He pyramided at exactly the wrong moment, at peak euphoria, at peak momentum, at peak volatility. And then he capitulated at exactly the second worst moment, during maximum fear. The professional saw the same $52 break. He recognized it as a valid setup, but he didn't pyramid into the initial momentum spike. Instead, he waited. He waited for a pullback, exactly what happened. When the stock retraced to $51, and then he waited for secondary confirmation. When the stock bounced off that $51 retest and started rallying again, then he pyramided. Now he's adding to strength after confirmation, not into panic-driven spikes. Volatility is lower at this point. His mind is clearer. He's not acting from euphoria. He's acting from data. The stock rallied from there to $58, and his larger position captured more of the upside. He won by waiting. The amateur lost by acting too fast. Here's the maxim, the one that should be tattooed on every trader's forearm: pyramid into calm, not into crisis. Volatility is a crisis. Momentum is noise. Euphoria is the enemy. Confirmation after pullback is calm. Reversal after test is calm. These are the moments, and the only moments, when you add to a position. Not when price is screaming higher. Not when your emotions are at maximum. Not when everyone around you is talking about the stock at a bar or in a chat room. Add when the market has paused, repriced, retested, and bounced. Add when your mind is clear enough to think about position sizing ratios and risk to reward. Add when you're not acting from emotion but from protocol. But here's the hidden layer most traders miss, the one that separates the mechanical pyramiders from the masters. Pyramiding during volatility isn't just risky, it's often the amateur's way of betting harder instead of trading smarter. You're not adding because your thesis strengthened, you're adding because your emotion did. Your dopamine receptors are firing. The market is validating you. Your brain is screaming, you were right, double down, get more exposure. And that's exactly when you should be doing nothing. That's when discipline means sitting on your hands. The inverse is equally critical and equally misunderstood. When you're holding a profitable position and volatility suddenly strikes. Against you, amateurs add. They double down. They interpret the pullback as a buying opportunity within their larger thesis. They think they're being contrarian and brave. What they're actually doing is betting harder on a thesis that's being tested in real time, when their emotional clarity is lowest and their fear is highest. Professionals recognize the difference between intratrade pullback and thesis invalidation. If the thesis holds, if gate 1 passes, if fundamentals are intact, if the longer-term setup is still valid, Then professionals sometimes add, but only after volatility has crested, only after fear has subsided, only after the retest has been confirmed and bounced, not during the spike, not during the panic, never during maximum volatility and minimum clarity. The pyramid rule, then, is really a rule about timing your conviction, not increasing it. You don't increase position size because you're more convinced. You increase position size because volatility has decreased and confirmation has increased. You add when the setup is clearer, not when it's cloudier. You add when you're thinking, not when you're feeling. That's the inverse of how panic-struck traders behave. They increase size when volatility is maximum and confirmation is minimum. They add to positions when they feel most certain, which is precisely when they should be most cautious. They're caught in a feedback loop of emotion disguised as conviction. And that feedback loop is exactly what turns 87% of pyramiders into blow-ups. The professionals who pyramid successfully, and there are very few of them, have learned to wait. They've learned to sit through the initial move. They've learned to let the market pull back and retest and confirm. And only then, when volatility has subsided and clarity has returned, do they add. That patience turns a good trade into a great trade. That discipline turns pyram. Iding from a 87% blow-up risk into a genuine wealth-building tool. But it requires the ability to watch profit happen without acting, to watch momentum build without joining the crowd, to sit still when every emotion is screaming at you to move. That's the real pyramid rule, not the adding, the waiting. Jesse Livermore's most profitable trades were the ones where he did almost nothing. This isn't poetic exaggeration. This is documented historical fact. He'd spot a setup, position himself, then wait. Not hours, sometimes weeks, sometimes months. The amateurs around him were scalping, day trading, rebalancing constantly, adjusting their positions, tweaking their thesis, moving in and out of trades like they were playing pinball. Livermore was sitting. He was waiting. And when the move finally came, when the market finally confirmed what he'd already positioned for, he was already there, fresh, undrained, and psychologically ready to pyramid into genuine confirmation. His competitors had burned themselves out making 100 small trades. Livermore had made one perfect trade by doing almost nothing. Here's what volatility teaches you if you're willing to listen. The traders who act the most lose the most. The traders who wait the most earn the most. This inverts everything your brain tells you. Your brain says action equals progress. Your brain says doing something is better than doing nothing. Your brain says the person who trades the most wins the most. Your brain is wrong. Your brain is optimized for a world where movement meant survival, run from predators, chase prey, keep moving or die. But trading isn't survival. Trading is the opposite. Trading is sitting still while your amygdala begs you to move. Trading is inaction while everyone around you is frantic. But waiting during volatility is psychologically excruciating. Your position is underwater. The tape is moving against you. Every nerve in your body is screaming to do something, do anything, adjust the position, take the loss, add to it, rebalance, close the app, open it again, check the news, call your mentor, post in the chat room. Something, anything but this, standing still. Amateurs mistake waiting for helplessness. They think inaction is surrender. They think if they're not doing something, they're losing. Professionals know waiting is the highest form of discipline. They know that the ability to sit still in chaos is rarer than the ability to act in chaos. They know that waiting is a choice, not a default. It's a deliberate, active choice to let volatility happen without your interference. A trader entered a position 3 days before an earnings announcement. His thesis was solid. The fundamentals supported a rally, but he knew earnings would create volatility. The stock moved -2% intraday against him on day 2. His position was down. Small loss, but a loss nonetheless. The amateurs holding the same position panicked. They saw red on their screens. They saw proof that they were wrong. They exited, taking the loss, locking it in, moving on. They needed the psychological relief. The trader with waiting discipline did something radical. He closed his trading app. He didn't check the price. He didn't monitor the tape. He didn't adjust anything. He trusted his thesis. He trusted his homework. He trusted that -2% intraday volatility was not evidence of a broken trade, but just the market doing what markets do. He returned the next day after earnings. The stock rallied 8% post-earnings. His inaction earned him more than any active trading could have. The amateurs who exited locked in a 2% loss and then watched the stock move 8% higher without them. The waiting trader captured the full move. This is the paradox that separates the 5% profitable traders from the 95% who fail. The more patient you become, the less you need to trade. This sounds backward. It seems like professionals should be trading constantly, adjusting constantly, optimizing constantly. They're not. Professionals are emptier than amateurs. They have fewer positions. Their theses are clearer. Their holding periods are longer. Their conviction is deeper. Amateurs are exhausted because they're constantly adjusting, rebalancing, and second-guessing. They're making 10 trades where professionals make one. They're checking their positions 100 times where professionals check twice. They're burning emotional fuel at a rate that guarantees they'll capitulate when volatility really strikes. Professionals are fresh. They're rested. They've made their decision, and they're living in it. The 1-minute panic formula includes a hidden gate that most traders never verbalize, never even conceptualize. Gate 3.5, the waiting gate. After you've passed all 3 gates and confirmed that your thesis is intact, your position size is appropriate, and your time horizon is aligned, the final question emerges: is my inaction more profitable than my action? This sounds abstract, but it's brutally practical. Every time you're about to make a trade adjustment during volatility, ask yourself this question: will this action increase my edge or decrease my anxiety? Will this action make me more money, or will it just make me feel better? If the answer is the latter, if you're adjusting because you're anxious, not because your thesis has changed, then the waiting gate tells you to do nothing. Sit still, close the app, trust the setup. Wait. Waiting is a position. It's not the absence of a position. It's an active, deliberate position that you're taking. It has risk. It requires conviction. It requires the psychological strength to watch price move against you and not react. But it's the position that professionals take when volatility is highest and options are most abundant. When everyone else is panicking and selling, professionals are sitting still, holding their thesis, and letting the panic happen around them. When everyone else is euphoric and adding, professionals are sitting still, waiting for confirmation, and letting the momentum exhaust itself. They're positioned either way. They're waiting for the market to tell them what to do next. The paradox deepens to almost Zen-like contradictions. The traders who can afford to wait the longest, because they sized correctly and have dry powder and haven't blown up their account on impulse trades, are the traders who wait the least, because they're profitable enough to not need to do anything. They're not watching screens obsessively because they don't need to. They're not adjusting constantly because their positions are working. They're not panicking because their sizing is small enough that volatility doesn't threaten them. The amateurs, desperate to recover losses, constantly trade. They're hunting for the one big home run that will recover the damage they've done. They're the busiest, poorest traders on the exchange. They're making 5 trades a day when they should be making 5 trades a month. They're checking their account every 5 minutes when professionals check every 5 days. They're slaves to the tape. Professionals own the tape because they've learned to ignore it. The waiting game, then, isn't about patience in the abstract sense. It's about understanding that price movement is noise and your thesis is signal. It's about the discipline to distinguish between the two and act only on signal. It's about the maturity to admit that you don't need to trade every setup, every pullback, every volatility spike. You need to trade the setups that matter, ones where you've done your homework, where your thesis is clear, where your sizing is appropriate, and where your time horizon is aligned. Everything else is noise. And noise is the enemy of wealth. Noise kills accounts. Inaction against noise, waiting, sitting still, doing nothing, is what builds wealth. That's the lesson Livermore taught. That's the lesson volatility teaches if you're willing to listen. Here's the final truth that separates temporary traders from lifelong professionals. The 1-minute panic formula only works if it becomes part of your identity, not just your checklist. This distinction is everything. This is the gap between knowing and doing, between understanding and embodying, between watching a video and actually changing your behavior. Most traders will finish this video, nod in agreement, feel inspired, and then go back to trading exactly the way they've always traded. They'll encounter volatility, they'll freeze, they'll panic sell, and they'll wonder why the framework didn't work. It will never occur to them that the framework didn't fail. They failed to implement the framework. They failed to integrate it. They failed to make it part of who they are as traders. Amateurs treat trading rules like diets, something external, something imposed, something to be followed when convenient and abandoned when inconvenient. They read about position sizing and think, yeah, I should probably size smaller. Then they encounter a setup they really like and they size bigger anyway. They read about stop losses and think, yeah, I should definitely set stops. Then they encounter a position they're afraid to lose, and they move the stop loss instead of taking the trade. Rules applied inconsistently are no rules at all. Rules are just suggestions. Suggestions are just noise. And noise is what amateurs trade in. They're governed by convenience and emotion, not discipline and protocol. Professionals treat rules like their heartbeat. Invisible, automatic, non-negotiable. You don't decide whether to keep your heart beating. You don't negotiate with your heart about whether it should pump blood today. Your heart just beats. It's automatic. It's beneath conscious thought. That's what integration looks like. That's what you're building. Not a conscious checklist that you run through every time. Not a set of rules that you follow sometimes. A nervous system response. A way of being. An identity. Think about a pilot in turbulence. He doesn't reach for a manual and think through each step. He doesn't call ground control and ask what to do. He's rehearsed the emergency protocol 100 times, 1,000 times. His hands move automatically. His voice stays calm because his nervous system knows exactly what to do. He's not thinking. He's executing muscle memory. That's the level of integration you need with the three-gate system. You need to reach a point where volatility strikes and your hands move through the gates before your conscious mind even recognizes that panic is starting. That's integration. That's the difference between survival and capitulation. Here's exactly how to build that integration. First, pre-decision rehearsal. Before you trade with real capital, simulate panic scenarios. Open your trading journal or a blank document. Scenario 1, a stock gaps down 5% against your thesis. Walk through gate 1. Thesis, check. Is the thesis intact or broken? Walk through gate 2, sizing check. Given the new volatility, is the position size still appropriate? Walk through gate 3, time horizon check. Am I in the right trade for the right time frame? Make a decision. Do this 50 times, not thinking about it, physically doing it, writing it down, going through the gates. Scenario 2, a position you hold is up 8% in 1H. Hour, euphoria is hitting. Do you pyramid? Walk through the gates. Scenario 3, you're holding a swing trade. The market gaps against you, your stop loss is hit. What's your next move? Walk through the gates. You're training your neural pathways to respond automatically. A successful trader in Singapore told me she spent 2 months simulating crashes before she risked real money. 2 months. While other traders were jumping into live accounts, she was walking through scenarios, writing down her decisions, practicing the gates. She did this because she understood that the first real crisis she encountered would determine everything. If she froze in that first crisis, she might blow up her account and never trade again. If she executed, she'd build confidence that would carry her through a lifetime of volatility. When the actual crash came, a 12% gap down in one of her holdings, her hands moved through the 3 gates like muscle memory. She didn't think. She executed. Gate 1, thesis intact, fundamentals hadn't changed. Decision, hold or adjust. Gate 2, given the new volatility, position size was too large. Decision, reduce 40%. Gate 3, time horizon was a 3-month thesis. This was a 3-day panic. Decision, hold the rest. She exited 40% with a small loss, held 60% knowing her thesis was intact. Most traders in that market capitulated entirely. They took maximum losses. They blew up accounts. She made money. Not because she was smarter, because she'd rehearsed. Second, emotional anchoring. Every time you pass all 3 gates and decide to hold, say it aloud. I've checked my thesis. I've checked my size. I've checked my horizon. I'm holding. This sounds absurd. I understand why. It sounds like self-help nonsense. It's not. You're binding your intellect to your action. You're creating a verbal contract with yourself. You're forcing your conscious mind to acknowledge the decision that your gates have already made. This matters. Because when panic hits, when real money is at risk, Your amygdala will try to override the decision. It will scream at you. It will tell you to sell everything. And if you haven't verbally anchored your decision, you'll listen to the amygdala. If you have anchored it, you'll remember, I've already checked these gates. I've already made this decision. I'm holding. That verbal anchor is the difference. Third, skin in the game. Don't trade with money you can't afford to lose. Not because you'll be reckless. Most traders think this is about preventing recklessness. It's not. It's about preventing panic. Professionals trade fearlessly not because they're fearless. It's impossible to be fearless when real money is at risk. Professionals trade fearlessly because their position size matches their conviction. A 2% account risk on a $50,000 account feels concrete, manageable. You can think clearly at that sizing. A 20% risk feels terrifying, and should. Your fear is not a sign of weakness. Your fear is a signal of poor sizing. Your fear is your nervous system telling you that you're over-leveraged. Listen to it. Respect it. Size smaller until the fear subsides. Now you can think. Now you can execute the gates. Now you can become professional. The traders who master the 1-minute panic formula aren't more intelligent than others. They don't have access to better information. They don't have superior instincts. They're more rehearsed. They've written the protocol so deep into their neural pathways that when panic arrives, they're already 3 steps ahead. Their hands move before their fear does. Their gates activate before their amygdala hijacks them. They've built identity. They've built muscle memory. They've built a nervous system response. And here's the final loop, closing where we began. The trader frozen in the flash crash, the one who lost 40% in a single frozen moment. He hadn't rehearsed. He hadn't practiced the gates. He hadn't simulated crashes. He had no muscle memory. When volatility struck, his conscious mind was running the show. His conscious mind froze. The professionals who lost 2%. They had rehearsed. They had practiced. They had simulated. When volatility struck, their nervous system ran the show. Their hands moved through the gates automatically. They made decisions before they even felt the fear. You now know their secret. It's not genetics. It's not intelligence. It's not luck. It's rehearsal. It's integration. It's the decision to practice before the pressure arrives. That's what separates the frozen trader from the professionals. That's what separates temporary traders from lifelong professionals. That's what separates the 95% who fail from the 5% who survive. The difference is whether you've built the protocol into your identity or whether you're just reading about it. The choice is yours, but the time to choose is now, before the next crash, before the next earnings shock, before the next gap opening. Practice now. Rehearse now. Build the muscle memory now, because when the real volatility comes, and it will come, you'll either have the protocol or you won't. You'll either freeze or execute, and that single decision will determine whether you're a temporary trader or a professional. The rest of your trading career depends on what you do in the next 48 hours. Simulate 50 scenarios, walk through the gates, say the words aloud, build the identity, because muscle memory beats emotion, protocol beats panic, integration beats everything else.